Welcome back. Okay, if you've been keeping an eye on the markets lately, there's no doubt you've noticed one very prominent name just taking an absolute beating, and that's Robinhood. Ticker symbol HOOD. We're looking at this fascinating situation where the company is literally reporting record-breaking revenues, but if you look at their stock chart, it looks like it's just falling off a cliff.
So, let's dive right into this. That massive disconnect brings us to the core question we're going to investigate in today's explainer. Are we looking at a prime, golden opportunity to buy the dip, or is Robinhood stock just a classic value trap waiting to catch unsuspecting investors? We're going to unpack this market's seemingly contradictory reaction and figure out what is really going on beneath the surface.
To really grasp the situation, we gotta look at the damage. Robinhood is down nearly 40% from its 52-week high, trading right around $95 a share. Now, for a company that's historically been an absolute darling of retail investors, a 40% haircut, that's severe. It's a huge flashing signal that the broader market is deeply, deeply concerned about something.
But here is where our detective story really kicks off. Because that plunging stock price, it's directly contradicting the reality of the actual underlying business. Think about this. Robinhood is posting record revenues. They're aggressively adding gold subscribers. They even just launched crypto trading over in the UK, so they're expanding their global footprint. The business is clearly growing, but the valuation is inexplicably shrinking. So here's exactly how we'll break down the clues today. 1. The Robinhood paradox. 2. Crypto versus core. 3. Under the hood. 4. Technicals and sentiment. 5. Risks to watch. And finally, number 6. The verdict.
All right. Jumping right into part 1, the Robinhood paradox and analyst disconnects.
Right now, Wall Street is sending some seriously mixed signals. On one hand, you've got Truist Securities. They recently reiterated their buy rating with a $130 price target. And they absolutely love the fact that Robinhood just pulled in $5.6 billion in net deposits in July, along with some record-breaking options trading volume. But then, on the exact same token, you have firms like Barclays and Needham coming in and trimming their targets down to 105 and 120. Why? Well, they're pretty worried that these new initiatives, things like Robinhood's big push into banking services and prediction markets, are simply going to take way too long to actually pay off.
Moving on to Section 2, crypto versus core and the media narrative.
So there's this really stark juxtaposition going on right now between the mainstream media narrative and reality. Look, the media ran wild with the headline that Robinhood's crypto revenue plummeted by 38% year over year, falling down to $100 million. And yeah, that is totally true. But you know what they completely glossed over? The massive, almost 60% year over year growth in Robinhood's core brokerage segments. I'm talking equities and options.
When we actually break down the Q2 revenue mix, a totally different picture emerges. Crypto is now making up just 8% of Robinhood's total revenue, just 8%. The other 92% is being driven by that booming core business. This kind of proves that the market might be severely overreacting to the whole crypto slump. Think about it. People are punishing the stock for an 8% slice of the pie while completely ignoring the 92% that is thriving right now.
All right, Section 3, under the hood, looking at the fundamental analysis.
Just look at these numbers. Revenue came in at $1.308 billion, which is up 32% year over year. Earnings per share hit 62 cents. That is a huge 47% jump from last year. And those gold subscribers, which represent that highly coveted, predictable recurring revenue, they grew by 39%. Make no mistake here, these are objectively fantastic growth metrics for literally any company. The growth engine is undeniably firing on all cylinders.
So it begs the question, why the 40% drop? Well, it all comes down to valuation. Robinhood trades at a price-to-sales ratio of 17.3. Now compare that to a traditional brokerage giant like Charles Schwab, which trades at a P/S of just over 7. Plus, Robinhood's price-to-earnings ratio is sitting at a really lofty 42. That means investors are paying $42 for every single dollar of profit. It's priced for absolute perfection. In fact, some fundamental models put its intrinsic fair value closer to $62. If that's right, it could potentially be over 70% overvalued at current levels. High growth is amazing, sure, but Wall Street is actively questioning if it justifies a premium this steep, especially with their highest margin segment, crypto, slowing down.
Let's pivot to Section 4, Technicals and Sentiment, taking a look at the charts.
Technically speaking, guys, the picture here is pretty bearish. HOOD is firmly locked in a near-term downtrend right now. It's trading below both its 20-day and 60-day moving averages. Just over the last month alone, the stock has shaved off over 13%, and if you look back to March, we're seeing this textbook pattern of lower highs and lower lows. For short-term momentum traders, this is basically a giant, glaring red stop sign.
But, there's always a flip side to the coin, and here it's represented by the number 2.3. That is Robinhood's beta. Now, a beta over 2 basically means the stock is incredibly volatile compared to the broader market. It moves nearly twice as much as the S&P 500. So if you're someone who believes a broader market recovery isn't imminent, Robinhood could actually act as a highly leveraged, outperforming play. When the market rips higher, Hood tends to fly right along with it, bringing all those wild swings we've come to expect from retail favorites.
And interestingly enough, management seems to be betting on exactly that scenario. Right now, they have $1.37 billion remaining in authorized stock buybacks. This sets up a really fascinating sentiment mix, right? Average analyst price targets are dropping, sure, but management's massive buyback authorization heavily signals that they think the stock is undervalued, and they see true value here. It is a classic high-stakes battle between Wall Street analysts and corporate insiders.
Which brings us to Section 5, Risks to Watch, and the 3 major headwinds. Risk number 1, crypto volatility. Yes, as we said, it's only 8% of revenue, but it is an exceptionally high-margin product for them. If we enter a prolonged crypto bear market, it's going to drag down their overall profitability. No question. Risk number 2, regulatory headwinds. Robinhood just recently caught cease and desist orders regarding their sports bet contracts. State regulators are watching this company like a hawk, and any regulatory hurdles like that can seriously delay their whole strategy to diversify revenues.
And finally, risk 3, which is perfectly encapsulated by this number right here, 80,000. That's the number of new funded accounts Robinhood added in July. Now, 80,000 might sound like a huge number, but for Robinhood, it actually represents just a 3 to 4% annualized growth rate. That's a noticeable deceleration from previous months. Look, if you're going to command a premium valuation with a PE of 42, you simply cannot have slowing user acquisition. This is a major red flag that the market is acutely focused on right now.
And that leads us to Section 6, the verdict and our actionable takeaways.
This quote really hits the nail on the head and summarizes everything we've covered in this explainer today. Robinhood truly is a tale of two stories. On one hand, you have an undeniably booming core business, but it's being somewhat masked by a slumping crypto segment, and the whole shebang is wrapped up in a really expensive valuation that leaves virtually zero room for error. If you're a long-term investor who believes Robinhood is going to successfully transition into a full-service financial super app, then using a dollar-cost averaging strategy during this 40% dip, that makes a lot of logical sense. You're buying into the underlying business growth. However, if you're a short-term trader or you're just highly risk-averse, this current technical downtrend and that super stretched valuation strongly suggests you might want to wait on the sidelines. Let the charts show a definitive reversal in momentum first.
So all the data is laid out for us, and that next earnings report is absolutely going to be the crucial catalyst to watch. But I want to turn it over to you and your own strategy. Based on all the clues we've unpacked in this explainer today, are you buying the dip, selling the rally, or are you simply holding hood? Take these insights, apply them to your own personal risk tolerance, and just make sure you have a really solid plan before you make your next trade. Thanks so much for joining me for this breakdown. Weigh the clues, map out your strategy, and ask yourself, is Robinhood your next big catch, or are you stepping into a trap? I'll see you in the next one.